Thank you, Olivia. Thanks everyone for coming back from lunch and for still being here at the conference. One of the hazards of being a keynote speaker every year, so to speak, is to forget whether or not I told a joke last year or the year before, the same one. And since I have limited number of jokes, the chance of that happening is quite high. So I'm not even going to attempt that. But I'm sure last year I was beginning to talk about my perception about the credit markets and whether or not we were again experiencing a bubble in the credit markets. Perhaps you don't remember if you were here last year, but it was the very beginning of my thinking on this subject. And a lot has happened in the last year, perhaps to solidify our thinking. But what I'd like to do today is bring you up to date on our perception of the evolution of credit markets, primarily in the United States, but since this is a European conference for the most part, and of course the venue is the epicenter of European finance. I know there are others like in Frankfurt and London and Athens perhaps. But obviously what is going on in Europe today is central to the world's interest in not only the European situation but the global situation. And the question of is it a bubble needs to be refined with respect to the credit markets. We have had many bubbles, so to speak, on asset prices over the last several thousand years. And bubbles are not that unique. And I will try to define a bubble much more in terms of the default phenomenon, rather than a price level that only you know after the fact was in fact a bubble. But I can point to a 2 standard deviation or 3 standard deviation year clearly as a bubble, not only in terms of probabilities, but in terms of its impact. And so I will define a bubble with respect to credit markets as a significant increase in default rates in the relevant population. And the relevant population, for me, has always been the private sector. However, since the last 5 years in Europe has focused more on the sovereign area, I would like to also make some comments about sovereign defaults, and particularly and I hope Klaus will refer to it as well, the situation in the, particularly in the current situation and in Greece in particular. But that may or may not be relevant to what I'm going to say, but we will find out. Now, let me give you one anecdote as to the relevance of speaking about the credit risk situation and the potential of a bubble bursting. And I'd like to emphasize also the similarities today with 2007. 2007, as you may remember, was just before the bubble burst. And the epicenter was New York, as it may be the center of risk-taking in the world, and also the mortgage-backed securities that were emanated from the banks in the United States, and of course spread to the rest of the world. And the anecdote had to do with a speech I gave in December 2006 in Montreal for a large French bank. It was, I think, Société Générale, and they were having their North American division meeting, and I was outlining why I thought a bubble was about to burst. But my concern was the corporate sector. My perhaps more flamboyant colleague, Norio Rubini, was talking about of course, the mortgage-backed securities market as we got closer. And he was correct in saying that that was where the bubble eventually burst, and then it impacted the rest of the world. But I was worried about the increasing risk levels, much more than I thought was prudent in the corporate sector. And at the end of the speech, the president of the bank called me aside. He says, you know, Professor Altman, that was a very convincing talk. If I understand your message, as a president of the bank, I should be hedging my risk, reducing my exposure, maybe even shorting credit through the CDS market or another market that they could play in directly by shorting securities. And I said, well, if that's the message and you think it's correct, I would go along with that. He said, yeah, but I don't have the courage to do that. And I said, well, I don't understand. If you think it's the right strategy, given the situation, I don't understand what you mean by courage. He said, well, you obviously don't understand my job. I said, yes, that's why I'm a professor and you're a bank president. and he said, yeah, well, by the way, there are countries of the world that professors are bank presidents. And my good friends here in Italy know that the case. It seems like, you know, in Italy, you could be a professor and a chairman and a president of a bank at the same time, and somehow or other you can get away with it. We don't let that happen in the U.S. very easily. Also, you can go from a professor to be prime minister in 3 days, which is, you know, pretty amazing. But it happens. And, I think it was 3 days. At any rate, I said, well, I don't understand. Why do you need, what do you mean by courage? He said, well, you don't understand my job. If you are right, and I follow what you're saying, and in fact, the bubble does burst, I'm going to be a hero and get a big bonus, a very large bonus. But if I'm wrong, and the train keeps speeding down the track, and the music keeps playing, so to speak, and everyone keeps dancing, and I got off the train, when I stopped dancing, I'm going to lose my job. And so it is actually a lot of courage to reduce your risk when everybody is piling on the risk. And I see some of the same things happening in the United States today. And one of my objectives this afternoon, is to talk about whether or not I see that happening in Europe as well. And the punchline I'm going to mention to you is I don't see it happening as much as in Europe. To use a baseball analogy, or let's say a soccer or football analogy, the United States, I feel, in the credit cycle is probably within 10 minutes of the end time, or even closer to that. Whereas Europe, in the area of credit risk-taking, is very much in the early stages of the game. But the question is, how will Europe react, and the rest of the world, Asia as well, if there is a bubble in the United States and it begins to burst? How quickly will the rest of the world catch up to that, or will they be insulated because they have not taken the same amount of risk going forward? Lots of words here. Is it a bubble, or are we just talking about optimistic debt financing on the part of companies and sovereigns? You know, there was a lot of very famous work done in the 60s and the 70s in corporate finance about their timing and opportunistic debt versus equity financing, the so-called trade-off theories with respect to corporate finance and optimum capital structure of companies. And it said, of course, take advantage of debt when the cost of debt is low, and vice versa when the cost of equity is low. And so companies tend to move through a target capital structure, but maybe are in excess or below that, depending on the situation. So a lot of people are saying, don't worry about the situation today, it's just a manifestation of lower cost of debt financing available, and it's very rational to take advantage of it when you can. But if I asked the average American, and maybe the average European professional, to say whether or not the average company in the United States today is more or less healthy from a standpoint of credit risk than it was in 2007, I would guess that 90%, if not higher, of the audience in the United States would say the average company today is far healthier than it was in 2007. More profitability, more cash on the balance sheet, better GDP growth, and more profit opportunities. So one of the things I'm going to show you is a comparison using some of the models we built between a holistic analysis of the health of companies today versus 2007, just before the crisis. We're going to focus on default rates in credit markets. And let me just show you a graph that shows you default rates over the last, say, 30 or 40 years in the United States. And believe it or not, we've had 3 cycles of high default rates greater than 2 standard errors above the mean. And I'm talking about 10 to 12% default rates in the high-yield bond market. Now, I use the high-yield bond market or junk bond market as the benchmark because that is, of course, the area that has the most inventory that could default, and it is a very large market. Today, the U.S. high-yield bond market is $1.6 trillion. The European market for high-yield bonds, surprising to some people, has grown to over 500 billion US dollars, or 430, 440 billion euros. 1/3 the size of the US. And the Asian and South American markets for high-yield debt in the corporate sector is about 10% of the US market, about $120 billion. So notice we've had 3 cycles. Another thing, however, to notice is the length of the benign cycles in between the crisis periods. And these were crisis periods. This was not a metaphor for problems. If you recall what happened in 1991 in the United States, this was 2 things. One, the highly leveraged transactions, leveraged buyouts, private equity industry imploding with a huge amount of defaults and bankruptcies, bringing down Drexel Burnham, Michael Milken went to jail, and the risk financing abilities of small and medium-sized companies in the US, and particularly growth companies that are a little larger, was thought to end. And we were going to be back in a period of only bank financing. It didn't happen. And then the benign cycle that followed, I don't think I need a microphone for a moment. We're talking about 3 benign cycles in between the 3, let's say, crisis periods. The first, yeah, I could use it as well, right? The problem is, these things never are bright enough unless you go to Asia. They have these great... I'm sorry, the United States is first in Europe. You got these great pointers and they have this little dot. Does it work? Anyway, 7 years. Benign cycle. 4 years. Today we are, that's okay. It'll take more time to fix it. We are in the beginning of the 6th year. 6 years of a benign cycle. And I define a benign cycle as lower than average default rates in the corporate high-yield sector. The average default rate is about 3.5% a year. So less than 3.5% a year continuously now for into the 6th year. The longest it's ever been has been 7 years, since, say, the 1960s. Now, I'm sure there are some people out there, especially if you read the Rogoff book, who are saying this time it's different. And I've heard that before, and it is different. At least up to now it's been different, mainly on the role of the central banks in the world. First, the Fed, and by the way, the Fed deserves a lot of credit. I mean, I've been a great critic of the Fed when they were slow to move to this last crisis, which was 08, 09. We all know about that. The prior crisis was 2001, 2002, the tech bubble, followed by 9/11, and followed by a bad recession in the United States. And then the final crisis, one we're talking about, 08, 09. And they moved slowly, but when they moved very vigorously by pumping in $3 trillion worth of liquidity. The European Central Bank is now doing the same thing. Bravo to them, it took a long time. I know there may be some legal issues. In fact, I think in Germany right now, they're debating whether or not the buying of sovereign debt directly is legal. I'm sure that won't happen. Maybe they'll throw the suit out. But the point is the fact that the central banks are much more active today than they've ever been. This time, it's different. But that doesn't mean we should forget about fundamentals. And the fundamentals in the US are very bad right now. They're better, actually, in Europe, mainly because there's not much risk-taking in Europe. And this is a good thing and a bad thing. It's not a good thing for growth, but it's a good thing for avoiding credit crisis. Here is the default rate, by the way, situation in Europe, in the European high-yield market. So take a look at the European default rates. We had, again, 01, 02, 03, huge default rates, but it was a very small market, and it was concentrated in telecommunication companies. Then it fell down to a benign credit cycle starting in 2004, 1.9, 7.7, 1, 2, 3, 4, 5 years. Then we had 08 and 09, really 09 only, of above average. Now we are in 1, 2, 3, 4. Why? Can you tell me why the European default rates have been so low during the last 5 years when Europe has supposedly been in crisis? It has not shown up in default rates, neither in the bank's balance sheet or in the capital markets. This is the high-yield bond default rate. There's something about the fact that the European risk-taking has not manifested in this sovereign crisis in the corporate area, at least not among large companies. It's a very different story, however, among small and medium-sized companies. They have had very high default rates. It's been camouflaged somewhat by the emphasis on country risk. And I think it's something to keep in mind. So, the length of the benign credit cycle is something to watch. We are in the 6th year. Normally it doesn't last more than 4 to 7 years. Will it last much longer? Perhaps. But here is, I think, the wild card, and something that I'd like you to think about. The relationship between the real economy and default rates in the private sector. Now, the yellow bars represent recession periods going back to the early 70s in the United States. We are very fortunate in the United States to have many recessions and lots of defaults. And as a researcher, I'm sure out there, if I could ask how many of you have done some research on default prediction or default analysis, could you raise your hand? Yeah, at least 2 dozen. I am sure that most of you need to go to the United States to get a reasonably large sample. So, there's good news, bad news. We've got lots of defaults, it's a big economy, lots of risk-taking, and therefore model building is a lot easier. When you go to Europe, you have more difficulty finding large companies and even banks to default. And so in our research yesterday, Herbert Reichen was talking about how clever you have to be in Europe to find pseudo-defaults to use in your model building. Maybe things will change for the better or worse. But the point I want to make is the line graph represents default rates. And the last 3 crisis periods with default rates of greater than 10% was coincident with a recession, the yellow bars. So, here's a very easy caveat. While I think the bubble is building, we will not have another crisis in terms of very high default rates, maybe some government intervention, certainly a reduction in growth in large companies, unless we have a recession. But which comes first? The recession or an increase in default rates in the private sector? If this was a macroeconomic conference, I would wager that most professional economists would argue it is the real economy that drives the performance of the companies that are part of that economy. I would like to argue that it's not so clear, and if you look at the default rates prior to, If you look at the default rates prior to the last 3 recessions, you will notice that they started rising 2 and 3 years before the recession, except for the last one where the default rate started rising in the mortgage-backed market. So the point is, we can have a signal of problems in the sovereign GDP area by observing the performance of companies in that sector even before the recession is officially started. Let me move on and tell you about the current situation. We have a yield to maturity spread, that's the difference between the required rate of return on the part of investors and the risk-free rate today, of about 450 basis points in the US. For the first time, the European spread is lower than the US. It means that investors in European high-yield bonds are requiring lower risk premiums than in the United States, which I've never seen before. It either means that they're being foolish and requiring a very low return, or they perceive that the risk going forward is actually lower than investing in similarly rated bonds in the US. Okay, so comparing health of high yield versus high yield bonds versus 2007 2014. Let me take a guess, a census. How many of you think the US situation among companies, they are more healthy today than they were in 07, prior to the crisis? More healthy today, raise your hand. How many think less healthy? Okay, a couple of friendly bears out there. Well, I think the reaction here is about similar to what I would get in the US, more healthy. Well, we decided to run Z-scores, surprise, surprise, on the corporate sector in 07 versus 2012 and 14. Just to summarize, for those of you who don't have nightmares like I do about the model, here's what it looks like. And here is a Z double prime model, which is better for industrials than only manufacturers. Here's the results. There's too much data here, but let me give you the bottom line. The average Z-score today is slightly better, slightly insignificantly from a statistical standpoint, 2.03 versus 1.9 from 2007. Just marginally better. And if you look at the major criteria for health in the leverage sector, the debt to EBITDA ratio today is higher than it was back in 07. More debt per dollar of cash flow. The net debt, if you take out cash from the balance sheets, is actually much worse today than it was in 07. The debt to equity ratios are higher today. The only thing that's better today than in 07 is the cash flow to interest ratio. In other words, per dollar of interest in terms of cash flow is actually slightly better today than it was in 07. So my conclusion is companies today are no better or worse creditworthiness than they were in 07. So is that good news or bad news? Don't forget, that was just before the crisis. And the crisis, of course, started in other areas. Let me move on to new issues. And this is a very important distinction between the US and Europe. I look at, and I'll move along to this graph here, I look at new issuance. So the blue represents the United States new issuance of close to $300 billion a year in high-yield bonds in the last 3 years, and it's continuing in 2015. I don't know, is this yellow or green? What's the color of this?
Yeah.
Yellow? That's Europe. So notice what's happened in Europe. 57 billion outstanding of new issues. Last year, 120 billion. This year, moving in the same direction. Europe, high yield, is expanding dramatically. Why? Partially because the banks are not lending as much as they would have if they had less capital constraints. And secondly, for the first time, a European investor can diversify within Europe in high yield and not have to go to the US and quest for yield. This is very important. The percentage of high yield that are triple C's, the lowest quality, highest risk. In 2007, believe it or not, 37% of the new issuance were triple C's. It reached 26% in 2014. And then in the last quarter of 2014, it dropped to only 3.5% and now 11%. Now, why am I concentrating on triple C's? Can you guess the probability of default of a triple C company within 3 years of issuance? Anybody can guess what the PD is of a triple C new issuance? 3 years. If you said 33%, you'd be correct. 1 in 3 companies default within 3 years of a triple C interest. And 1 out of 2 companies default within 5 years. And yet, they're well accepted in the market today. Now, are we looking at the market because of this low interest rate environment or the quest for yield differently than we've done in the past? Is it a new paradigm? I don't believe in new paradigms, by the way, very easily. So I think this triple C new issuance is going to come home to haunt the US market. But Europe, it's only 3, 4, 5% of the new issuance are triple C's. So, prudent? Yes. Risk-taking? Less. Not so good for growth, but very good for lower default rates going forward. Last thing I know, I'm running out of time. By the way, here's a table for those of you in the actuarial industry that shows the probability of default by original rating. And if you believe in original ratings like I do, I think they do a good job on plain vanilla, you can see that the triple C cumulative default rate is 47% over the last 40 years for triple C's and 34% over 3 years. So if you get a copy of the PowerPoint, you can do your own math in terms of expected default rates. Last thing I want to talk about is purchase price multiples. This is the price that private equity firms pay per dollar of cash flow to buy companies in the leveraged finance market. And believe me, this market is booming, particularly in the United States, but also in Europe. If you go to some of the private equity conferences, particularly the one in Paris in November, you'll see how much money and people and how much partying is going on. And partying goes on when the bigger fool theory works well. And what is the bigger fool theory? It says it doesn't matter what I pay for that asset, there's a bigger fool out there that will pay more. And that is happening today, even more than 07. In 07, the average purchase price multiple for public to private, in other words, taking a public company and taking it private through a leveraged transaction, was 9.9 times, the all-time high. In other words, for every $1 of cash flow, they were paying $10 for the asset. This year, so far, 11.8 times in purchase public to private, and all other 9.1 then and 9.1 today. Point is, this market is very much like it was in 07, if not more risky. And they have so much money, they're paying outrageous prices just for the opportunity to sell it again within a short time to the bigger fool. And you know what happens to the bigger fool theories. Let me conclude. I'm about out of time, I guess. I got a couple minutes? Okay. just a couple. Debt to EBITDA ratios. For every dollar of cash flow, how much debt is on the balance sheet? The height was 07, 6.6 times in Europe, 6.2 in the US. Now it's 5.7 and 5.6 in the first quarter of this year and 5.8 in the fourth quarter in 2014. We're not quite at 07 level, but we're pretty close. Let me conclude. The markets for leveraged finance in the United States in the private sector are every bit as risky as they were in 07. I'm convinced of that. What is different is the role of liquidity in the system. Back then, there was huge amount of liquidity, not from the central banks, but from sovereign wealth funds, from hedge funds, private equity funds, insurance companies, and the like. Today, the liquidity is coming from the central banks and also private equity funds, hedge funds, less so sovereign wealth funds, but they're in there too. So we've got now an extra source of liquidity. Some of that money is hot money, which means can be turned off very quickly, and that of course leads to a bubble bursting. And the other is the role of the central banks. Now I think Klaus and other people will talk about Europe and the mechanisms that have been built up to deal with potential crises, whether they be in the credit markets or in the sovereign debt markets. Let me say one last thing about sovereign debt. You may remember that Herbert Reichen and I built a model for default risk of countries, not companies. And our central theorem was the health of a country can be observed by the health of the private sector within that country. And we looked at Europe in particular, starting in 2009, when that famous declaration on part of one of the past prime ministers of Greece was, things are much worse than we thought. And at that time, the CDS spread on Greek debt was about the same as Portugal, Spain, Italy, and it was only about an implied probability for 5 years of around 10%. Today, by the way, the probability, if you look at the CDS spread on Greece, is about 95, 98%. And it was 95% in 2012 when they did default. But back in 2009, if you looked at the health of the private sector of the Greek companies and the Spanish companies, and Italian companies and Portuguese companies, they were way higher, even then, than anything in the rest of Europe. And today, it's the same. Yes, Spain has improved a bit. Yes, Italy has improved a bit, so it's no longer going in the wrong direction. But do you know that 25% of the Greek companies have a probability of default of over 70% in the next 5 years? Reforms are necessary. You're going to hear about that. But how do you reform an economy where 25% of the largest companies listed on the stock exchange have a 70% probability of default over the next 5 years? It's going to be a real challenge, and let's hope they're up to that. Thank you very much.